year 2024 kicked off on a smooth note. Our three main asset classes, fixed income, equity, and alternative investments, delivered stable and positive contributions to our portfolios as investor sentiment remained strong and economic data showed no signs of imminent recession. Of course, we welcome these developments and we remain attentive and diversified as we may not be out of the woods yet. As one of our clients mentioned recently, investing is much like sailing. Unpredictable weather requires constant adjustments and an extensive understanding of the ocean. Similarly, in managing investments, it's our ability to adapt that guides us through both calm and unknown waters. Global equities experienced a steady rise with remarkably low volatility throughout the quarter. The tech sector maintained its momentum, with Nvidia alone accounting for nearly 40% of the return of the S&P 500. Sectors like industrials, energy, and financials are all catching the wind, which is a positive sign for market expansion. Nevertheless, we'll remain cautious with our exposure to U.S. equities as returns are concentrated in a handful of companies and the market is seeing historically high valuations. Developed markets in general continue to outperform, with the US and its currency maintaining their lead. Meanwhile, emerging markets have been affected as a whole by ongoing economic struggles in China, leading us to maintain little exposure in these markets. The fixed income market saw mildly negative returns as interest rates rebounded. Both Canadian and US 10-year bond yields increased, reaching around 3.6% in Canada and 4.3% in the United States. We do anticipate interest rates to go down sooner in Canada compared to our neighbors in the South. Economically, the US remained particularly strong, with robust job creation and manufacturing performance leading to an economic growth rate in excess of 3%. In contrast, the Canadian and European economies stabilized, with economic growth between 0 and 1%. Recent core inflation measures also showed disparities, with the United States at 3.8% compared to Canada at 2%. On the alternative investment front, the year began on a strong note, with positive contributions from all major segments, including private debt, private equity, private real estate, and absolute return strategies. Given the outlook for interest rates to decline in Canada, we've initiated a dollar cost averaging strategy to gradually reinvest some of our cash holdings back into the market. We use this strategy to mitigate the impact of market volatility and will continue to adjust our investment strategies to preserve and grow your wealth in these dynamic times. On behalf of the TWM Group, thank you for watching and see you next time.